Ladies and gentlemen, welcome back to the channel. Here in this video, I will get you caught up to speed on your news developments for the day today. Now, we do have big events coming tomorrow, as I expressed in prior videos. Today was going to be one of the slower days, and besides Donald Trump making some comments, there is a little bit of a give back from Friday's aggressive rally, but not much. And I do think we are in for a larger rally ahead. Now, specifically tomorrow, the expectations are really low for the data. So the odds are good that we come in better than expected and see a bit of a rally for markets. Now, keep in mind, the next 6 weeks or so, from roughly today until the beginning of October, we are in a seasonally bearish period for markets. Now, we're going to look at what Tom Lee says about this market. His expectation for the next 6 weeks is actually that stocks could fall a bit before rallying aggressively into the end of the year. Now, Ryan Dietrich says the event that we had on Friday was rare, with 90% of stocks going up and 90% plus positive volume on those stocks. The average return 12 months later is well over 20%. So I don't think this is the time to be getting bearish, even if we could have a weak seasonal period ahead. What will really determine whether we do have a weak next 6 weeks or so is how the economic data comes out. Long story short, if we start to get what looks like recessionary data, stocks are not going to do well in that environment. If we start to get data that looks good, stocks should do well over the next 6 weeks. But again, seasonals are seasonals, and well, they're kind of self-fulfilling. So we'll get into all of this in today's episode, give you a broader update on what's going on with markets, look at some of your bigger catalysts later this week, talk about NVIDIA earnings as well. Hit that like button and subscribe to the channel if you have not done so already. Ladies and gentlemen, let's get started with what Ryan Dietrich says about this market. Now, if you guys don't know who Ryan Dietrich is, he works at Carson Research. Carson Research and Ryan Dietrich have been right up there with like Tom Lee in terms of accurately predicting this market and giving out very useful information. Ryan Dietrich on X says Friday was a rare 90-90 day, meaning 90% of the volume and stocks on the NASDAQ or New York Stock Exchange were higher. These events tend to be quite bullish, with the S&P 500 higher more than 90% of the time a year later and up more than 23% on average. So yeah, it tends to lead to very positive returns following these events, which took place on Friday. Ryan Dietrich says 90-90 days were quite rare in the 80s and 90s, but we've clearly seen more of them since the global financial crisis. Bottom line, the action Friday was to be filed away as another reason we are still in a major bull market. Any weakness should be fairly contained and would be an opportunity. Now, this is some of the seasonal weakness that you could maybe expect to see between now and the end of September, okay, where stocks generally tend to move lower and end up falling close to about 2-3% in post-election years by the end of September. You could see the last little low here before you really kick things up a notch in October, a little bit of a slight drawdown early November, and then pretty much off to the races towards the end of the year. So as I've talked about before on this channel, I think from really mid-October through the end of the year is going to be really strong, and then I think 2026 is going to be really strong. My thesis for this has nothing to do with seasonality, okay? I think between now and, early October, we're still in the process, Wall Street is still in the process, I should say, of trying to figure out, are we going into a growth scare? How strong or how weak is the economy? And with each data set, it's going to bring new worries or new optimism, okay? And it's impossible to know from this perspective at this point in time what that data is going to look like later on throughout this week. So if that data disappoints, we could see some weakness. If the data comes in good, we're going to see strength. But I do think towards, mid-October, we're going to have a little bit better of an understanding that we really didn't get a growth scare. The economy is doing fine. At that point, you start to get into some seasonal strength in the consumer with consumer spending patterns. And I think the holiday season is going to be quite strong. And you start to get into that, more of the aggressive spending in about mid-October. Okay, people getting ready for Thanksgiving and Christmas and traveling a little bit more. And I think generally that's when the growth scare ends. Now, we've talked about this before on the channel, but everyone was back in May talking about a growth scare that was going to come in August and September. I mean, like, we're living through that right now, where Wall Street, I wouldn't say they're scared, but they're trying to figure out what's going on with the economy. Any bad data set is going to lead to more fear, especially with the seasonal weakness. And that's some of the risk that we have over the next 6 weeks. But I do think into the end of this year, it's going to become clear. The economy is doing fine. Inflation is on a downwards path. 2026 is going to be a good year. Inflation maybe even comes back to 2%. Obviously, we'll have to see. But trade wars hopefully are coming to an end by mid-October, towards the end of this year. Okay, AI spending still fully intact, doing fine there. We'll hear more Wednesday with NVIDIA earnings. And then we have a AI boom, right? Big beautiful bill, 100% capital depreciation for CapEx, right? Capital expenditures. So for an example, if you're a farmer and you wanted to buy a tractor, you can now write off 100% of that in the same year you buy it, instead of previously you could only write off 40%. This could spur a lot more economic activity than most people think. No tax on tips, no tax on overtime, up to $25,000 for no tax and tips, up to $14,500 for no tax and overtime. That could also be substantial, along with some of the other smaller provisions, like being able to write off interest on auto loans, things like that. Could really help boost this economy a little bit. Mix that with Wall Street's expecting 3 to 4 rate cuts this year. Okay? And I see the end of the year as a realization moment for most of Wall Street that, wow, the growth scare just didn't come. The economy's doing fine. Inflation's not a problem. AI's alive and well. And maybe the consumer and economy can do better next year. And really, as we get into the end of this year, the focus is going to be on 2026, right? Nobody's investing in stocks today based on, the next 2 or 3 months for the most part. People are more focused on next year, and people are just trying to figure out, how are things going to be next year? And I think by the end of this year, we're going to have a really good understanding that things are going to be better than where Wall Street is currently seeing them. For September 17th, the odds of a rate cut at 82.9%. Again, it's going to be up to the data. If the jobs report comes in really strong, the economy comes in really strong, these odds are going to fall. But that's not necessarily bad news, right? If the labor market were to be negative, let's say, in the next jobs report, that's going to be really bad. Stocks are not going to react positively to that, even though the odds of rate cuts would skyrocket. So you almost want like a not super strong, economy, not super weak either, but you really just want to see inflation continue to come down, right? That's what you want, or not, skyrocketing further, okay? October 29th. You're at 47.9% chance of just one cut by October 29th, a 44% chance of 2 cuts. And for December 10th, you're at 46.9% chance of 2 cuts and 32.3% chance of 3 cuts. So again, depending on the economic data between now and then, it's really going to determine how many rate cuts we're going to get. And that's why each data set is going to be important, and it's going to move the probability for Fed cuts. But remember, interest rate cuts are not in and of themselves bullish or bearish. The reason why the Fed is cutting rates is what's bullish or bearish. Think back to 2020. The Fed cut rates to 0 overnight on a Sunday. Stocks crashed the next day. Okay? Massive rate cut. stocks crashed. Why? Because that's saying, hey, the economy is about to go in the shitter, right? If we start getting really bad economic data, that's not going to be good for markets. Okay. In an ideal situation, you want to see the economy doing well, but inflation plummeting. That would be the best case scenario. But a more reasonable case scenario would be the economy holding up and inflation coming in lower than expected. Not necessarily plummeting, because we're still dealing with one-time price increases from tariffs. Difference between one-time price increase versus, long-lasting inflation, just to put that out there in case anyone was confused. There's a difference. I don't think long-lasting inflation is coming, but just one-time price increases are coming. And presumably the economy is not, crashing right now. Like, things are pretty steadfast, unchanged in my view. Tom Lee says this remains the most hated V-shaped rally. And what you can see here is Tom Lee is expecting, maybe some more strength in markets heading into around what would look to be like early to mid-September, and then to get another drawdown, okay, towards, end of September, around there, and then to get a larger rally. Now, Tom Lee, based on this, these arrows, would suggest like a pretty meaningful decline, right? It would suggest like a, getting back to like what on the S&P, like 600, which would be a huge decline, believe it or not. And then to power higher to 6,800 to 7,000, or 680 to 700 on the SPY. I don't think we're going to get anything like that. I think if we do get seasonal weakness, down to 620 on the SPY is about the extent of the fall that I could see from here. Like, something would really have to go wrong to get the markets to fall more than that. And from here, that would be like a 4% decline. Okay. We entered a new bull market once we broke prior highs. We're only like, 7%, 6% into a new bull market. Okay. And I do ultimately think we're going to hit 700 on the SPY by the end of this year, in my view. I just don't think we can go all the way down to 600 by late September, early October, and then go all the way back up to 700. So I kind of disagree with Tom Lee here. I think he's calling for a little bit more weakness than I am. But again, worth keeping in mind someone like Tom Lee and his opinions here. I just don't see the economy weakening that much to cause that much fear. Like, again, going from 645 or so, roughly where we are today, down to, let's say, 600 on the SPY, would be almost a 7% decline. Something would really have to go wrong to get that kind of a move lower, in my view. Let's get into your breaking news today in markets. It says China has to give us magnets. If they don't, we'll charge them 200% tariff or something. So that obviously does not sound great. Trump says it'll take us about a year to have the magnets. Trump says China's Xi would like me to come to China. Trump, on meeting North Korea's Kim Jong-un, says, I would like to meet this year. Trump says we'll have a lot of magnets in a short period of time. And Trump says that he spoke to Xi fairly recently. Trump says China and the US have tremendous power over magnets. Let's go ahead and get into all of your broader market breaking news today. Donald Trump says we're going to do numbers on the cost of drugs in the US. The US Commerce Department voids a $7.4 billion Biden-era semiconductor manufacturing research grant program. Trump says we will be reducing drug prices by 1,400 to 1,500%. Trump says we will put tariffs on drugs rapidly. Trump on the war in Ukraine says Putin is reluctant to meet Zelensky because he doesn't like him. Trump on the Putin phone call says we would like to denuclearize. Trump says every conversation with Putin is a good conversation. Trump says he has spoken to Putin since last Monday. Trump on the war in Ukraine says we spend no money on Ukraine anymore. Trump on the war in Ukraine says we deal with NATO. We don't really deal with Ukraine. And Trump says that Europe will give significant security guarantees. But he does say the US will be back up as far as security guarantees with the war in Ukraine. Trump on tariffs says we can use them to stop wars. And Trump, yet again today, touts Friday's stock market rally. Trump on Intel says they just made $11 billion for the US. And Trump on the Intel stake says, I want many more cases like it. And again, Trump on US stakes and companies says, I want to try to get as much as I can. And Trump on California redistricting efforts says, I think we'll be filing a lawsuit soon. Trump on South Korea says, I have heard there were raids on churches. I heard they got into US military bases. I won't stand for that. And nobody knows who they are. And Trump on policing says that they are prepared to order troops to cities even if the governor does not request. And Trump says there are some big personality conflicts with Russia and Ukraine. And starting today, if you burn a flag, you will get 1 year in jail. No early exits, no nothing. Donald Trump today signed an executive order essentially canceling cashless bail. Vice President Vance says Russia has offered significant compromises towards a Ukraine peace agreement. Now, furniture tariffs will be imposed as part of national security investigation into lumber, CNBC citing a White House official. This morning, we had some regional data. The Chicago Fed National Activity Index came in at negative 0.19. The estimate was 0.2, so that was pretty much in line with expectations, maybe a little bit better. But again, the smaller data sets are not going to move the markets. New home sales for July came in at 0.652 million. The estimate was 0.63 million, so that came in a little bit better than expected. New home sales month over month came in at negative 0.6%. The expectation was negative 1.1%. So again, a little bit better than expected. Dallas Fed Manufacturing Index came in at negative 1.8. The expectation was positive 0.2. So that was a little bit worse than expected. Now, as we said in the last video, Monday is the slow day, okay? As far as economic data, things really start to heat up on Tuesday with durable goods orders, CB consumer confidence, S&P Case-Shiller home price, durable goods orders excluding defense, non-defense orders excluding air. Some of these, again, durable goods orders excluding transportation. Some of these will be a main highlight to watch as well. But I'll tell you now. Tomorrow, we're expecting -4. Last month was -9.3 for durable goods orders. So like we don't have high expectations or high hopes for durable goods orders tomorrow. That could mean an upside surprise, and that would be positive for this market. As I've talked about before in previous videos, we are in a seasonal period of weakness right now between really now and the end of September into early October for the next like 6 weeks, okay? Seasonally, it's a weak period. We just got through earnings that smashed expectations. We have NVIDIA earnings this week, and we'll look at the earnings calendar in a moment. Assuming NVIDIA comes in probably better than expected, which I think is a pretty fair assessment. The Fed's blackout period starting here soon. The only thing we're really going to have to react to is going to be economic data. And that's going to maybe change a little bit the Fed's path of rates. For an example, if the economy comes in really strong, economic data comes in really strong, I should say, but inflation comes in really hot, we get a PCE report on Friday, that may temper expectations for Fed cuts. That could be a weakness on markets. But generally, what you need to know right now is you want economic data to come in as strong as possible. The stronger, the better, okay? Because stocks are going to materially decline, maybe go through a correction, if the data starts to look more recessionary. That's the big key. Do we get recessionary-like data? Again, tomorrow, we have really low expectations for durable goods orders. I wouldn't be surprised if that comes in positive. Again, you're looking at a month-over-month change here, and last month was negative 9.3%. You're expecting another negative 4%. So theoretically, if we come in at 9.3% positive, the last 2 months basically cancel themselves out, right? It would be like 0% durable goods orders growth, right? If you come in at negative 4%, that's a really rough number, okay? It's priced in, If we do come in at negative 4%, I don't think it's a negative, but if we come in higher than that, that is certainly going to be a positive. Wednesday is a slow day as far as economic data. On Thursday, GDP growth rate quarter over quarter, second estimate for Q2. Kansas Fed Composite Index, Fed Waller will speak, some other bond auctions, smaller data, let's just call it. On Friday is your real big day as far as economic data with core PCE month over month, personal income and personal spending. There could be some upside to these numbers as well. Specifically, personal spending you want to see come in as high as possible. And again, you want to see PCE come in as low as possible. So Wall Street just waiting around for Friday. Now, as far as the earnings lineup, today in after hours, again, not much of anything. Tomorrow, pre-market, BMO, Scotiabank. Tuesday in after hours, Okta, MongoDB, Box, PVH, Joy, and some others. And then Wednesday, Kohl's, Abercrombie & Fitch, JM Smucker, Williams-Sonoma, RBC in pre-market. Wednesday in after hours, NVIDIA, Snowflake, CrowdStrike, HP, Viva, Five Below, Pure Storage, and NetApp, as well as Urban Outfitters. Thursday, pre-market, Dollar General, Best Buy, TD Bank, Burlington, Dick's Sporting Goods, Ali. And then Thursday and after hours, Marvell, Dell, Ulta Beauty, Centennial One, Affirm, Gap, Ambarella, Elastic, and Petco. And then Friday pre-market, you have Alibaba. Now, I know people are going to get nervous heading into Wednesday and NVIDIA's report, but betting on NVIDIA to have bad earnings has been a losing strategy for years. There's no sign to me that the AI build out is slowing down anytime soon. Like there's no reason to be bearish on NVIDIA earnings in my view. Some people have talked about NVIDIA excluding China revenue from some of their forecasts, meaning guidance could come in a little bit low. Not really NVIDIA's style. I don't really see like some disaster coming, but the stock's up a lot. Could you see a little bit of a, fall on expected earnings coming in? Sure. But NVIDIA is not going to be the catalyst that sparks, some kind of large downside in markets, in my view. And here again, just a look at the broader indexes. The Dow is down around 0.5%. S&P is down 0.03%. NASDAQ up 0.33%. Russell 2000 down 0.5%. And the VIX is up around 0.5%. 10-year Treasury yields are up about 3 basis points to 4.287%. Oil is up about 2% today to 64.89 per barrel. Okay. And gold slightly down today. Cryptos, again, slightly down today for Bitcoin. Ethereum down about 4.5%. Solana down about 4.3%. Dogecoin and some of the other cryptos down even more than that. So it is kind of a risk-off day a little bit. I think it's a digestion of the Fed and kind of a reaction post pretty euphoric rally on Friday. But I don't think, again, I think we're going to see a bounce back to risk. I think the next, 6 weeks are a little bit of a toss-up, but into the end of the year, things are going to be really strong for AI, small caps, financials, cyclicals, kind of under the same view of like Tom Lee here, okay? You're going to see a pretty aggressive rally in some of your risk-on stocks like small caps, like AI, like high beta. I think that's really the place to be from mid-October through the end of this year, and especially into 2026. With that said, the CNN Fear and Greed Index today is coming in. Let's refresh this. I don't think that's accurate. I guess it is. It's coming in at 61, which is in greed. Market momentum is greed. Stock price strength is greed. Stock price breadth is neutral. Put and call options is greed. Market volatility is neutral. Safe haven demand is greed. And junk bond demand currently in greed. We did just have the AI investor sentiment survey last Thursday. Bearish investors came in at 44.8%, neutral investors at 24.4%, and bullish investors at 30.8%. So, you have a lot of bears right now. The historical average is 31%. So you're like 14% higher than the historical average for bears. You're like 6% lower than the historical average for bulls. And you're about 6% lower for the historical average in neutral investors. So there's a lot of people that are bearish on this market, that are on the sidelines, maybe that are shorting this market, that are waiting for the ball to drop here for stocks and to see a larger, correction event. I just don't see that as a likely outcome from here. Could we chop around? Could you get some downside? Anything's possible, but I just don't see the huge growth scare that is what is typical of corrections coming. I just don't foresee that. Now, the percent of stocks trading above their 50-day moving average only down about 1.83% today to about 66%. So markets still look pretty strong. Like, you're not really giving back the Friday's rally much at all today. So let me know your thoughts on this down below in the comment section. Hit the like button, subscribe to the channel if you have not done so already, and check out that link down below in the description of this video for the trading community. If you guys want to come potentially invest in 10, 20, 30x opportunities, well, I believe taking on less risk by investing in quality companies, not dog shit companies, quality companies that Wall Street just does not know about yet, that do not have a large retail investor backing. I view, if you could buy a quality company with similar prospects to like SoundHound or BBAI, like long-term growth initiatives, better markets perhaps, that are trading at a third of the valuation, 25% of the valuation, I just think that is a valuation arbitrage because those companies are well known and these other ones are not. Again, I'm not a financial advisor. I'm not a financial planner. You could lose money. Always, always, always contact a professional before you make an investment decision, because I am simply just documenting what I am doing, and I am not a financial advisor. Even though we are outperforming 98%, 99% of hedge funds and institutions, there's no guarantee that that will continue. With that said, ladies and gentlemen, have a great rest of your day, and I will see you in the next one.